All right, so now after we have created our financial model, let's just talk a little bit more about what accounting means and how it plays into our plans, okay? So if you've taken any of my accounting classes or even this class, if I see you in 10 years from now and you cannot tell me what the accounting equation is, I will immediately hate you. So let's just go over what the accounting equation is and what it means so we all have common ground. The accounting equation, which is the balance sheet equation, is assets equal liabilities plus shareholders equity or owner's equity, okay? It's very simple. Number one, whatever you have for assets should be offset by the addition of your liabilities to your shareholder equity, okay? Again, this is not meant to make anybody an accountant, a CPA, or any type of accounting expert at this point. This is just more the overall basis, and especially for your business plans, you don't need to be an accountant. If you have some lack of accounting knowledge, that's why this is a group project, and that's why you have some people where this may be their strength. So for example, when we're looking at the accounting equation, an asset, your asset may be your house, right? Could be your car. From there, it is your liabilities would be that mortgage on the house or whatever the outstanding balance is on your car payment. And whatever the difference is between your liabilities and the value of your house is what you have in equity. So for example, I own a house that's worth $100,000. My mortgage is $70,000. Therefore, I have $30,000 of equity. It's really that simple. Again, we could go into debits and credits. That's not this class. That's one of the other classes I teach, and it's much worse than this one. So real quick, what do we see in assets? We talked about our house, but in a business, in our assets, one of our favorite assets is cash, right? Easy to measure. It's what's in our bank account, but we might have accounts receivable. You know, what should our accounts receivable be for our donut shop?
The net payments that are coming.
Right, but our total accounts receivable should be $0 because we're not letting anybody buy on credit.
Exactly. Cash flow.
Yep, cash flow. But that's a good point, because if it was a company that did so, going back to our cash flow model, we might say, hey, here's the bill for your product. It's due in 45 days, and that's 45 days we don't have cash. You also have inventory. All of our ingredients, everything that's in our shop, our cups, our plates, our furniture. We talked about how important our furniture was. Then we could have land, machinery, and these are just examples of asset accounts. Our liabilities, well, our mortgage is nothing but a loan. Accounts payable, the opposite of accounts receivable. We buy something, they bill us, we have 30 to 45 days. How can we leverage when our bills are due versus when we're getting paid? Again, don't need to go into that level of detail for this cash flow model, but in your business plan idea, that actually may be the case. Credit cards. There are a lot of people that fund their business off of credit cards. There are a lot of people that fund their life off of credit cards. Against that. But there are times where credit cards are useful in starting your business. Again, at what point does it start to affect you negatively personally, or what you're willing to lose as an investment? And then shareholders equity. That is what you own within the company. So for example, in that last example, we said we're going to put $75,000 into Nana's Donuts, right? We have $75,000 in cash as an asset. We have $75,000 as equity. No liabilities. We self-funded that company. But it could have gone several different ways. We may have only been able to put in $25,000, but borrow $50,000 from the bank. Therefore, we'd have the liability of $50,000. Going into shareholders' equity, that is where our income statement comes from. And the format of our cash flow model was just that of an income statement. No different. We go through what is our sales, what is our cost of goods sold? We come up with our gross profit, our less our expenses, to come up with our net income. So as we talk about what it takes to bring in liabilities and equity and what those assets are that we're trying to acquire for our business, we're going to start taking a look at what we need to, what has happened with some of the other companies. When we start talking about funding in our next segment, we're going to talk about Clean Juice in that interview, how a former real estate broker left his business to start a retail juice company. And no different with what you heard in the Clear Collar is how they went out and raised over $2 million in funds from investors. And what was needed for Clear Collar? Well, one of the most expensive things they needed were molds, big steel hunking molds that would produce their product. Those alone were probably 45% of the entire cost of what their company was. So at that point, when you look at $2 million and see that, $900,000 of that was buying this asset, you can kind of see where does financing come into place. And we'll also talk about in funding, when liabilities and equity gets to be more of a decision that you have to decide on what the expense is of giving up ownership versus giving up or taking on further debt. As we talk about what our balance sheet is, and what our income statement is, I've made it clear that the income statement is what feeds the equity. After we have made our investment and started our company, all of our sales, cost of goods sold, and expenses, and what is left over as net income, is the value we create each individual period. Based on our forecast, that was our total cash inflows or outflows. That is the value created. Our balance sheet is what we have and what we use it to create that value.
Thanks for watching. Make sure to subscribe to our YouTube channel at youtube.com/NexagyEducation or visit CasmerWard.com to catch up on previous episodes.